Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. Okay, I want you to use your imagination. There's a guy, and he's coming at you with a knife. Good thing or bad thing? Now, you might intuitively say, probably a bad thing that there's a guy coming at me with a knife. But what if there's a guy behind him carrying a big roast on a platter, and the guy with the knife is about to carve it up and serve it for you? So that's good news, right? So you see, the same scenario could be a good thing or a bad thing, depending on the context, depending on what else is going on around it. And to really understand a situation, you kind of have to look around, right? You have to understand what's going on around you. And I think this need for context is particularly important as we look at yesterday's CPI report, the Consumer Price Index, or as some people call it, the inflation report. I don't think that's a good name for it, by the way, because the CPI doesn't really measure inflation. It measures how much a basket of goods has gone up in price, how much more this particular basket of goods costs. And of course, the basket of goods was created by the government. So it has a vested interest in minimizing inflation as much as possible. I think that's always important to keep in mind. And so it doesn't really measure inflation, but it does tell us kind of what's going on in terms of price levels in the economy. It gives us at least some kind of picture of the inflation situation. So I'll be fair with that, I guess. But if we look at yesterday's report, there are definitely signs that price inflation is creeping higher. We saw an uptick in a lot of prices in June. And of course, that's bad news for everybody who's hoping for interest rate cuts, which is pretty much everybody. I think the kind of consensus is, hey, we need to cut rates, and the Fed is kind of dragging its feet because they're still concerned about inflation. And of course, if we're seeing those pressures in the economy, well, it's going to give them even more pause. So nobody wants that. However, if you dig into this report, there were enough dovish points in the data to support those who are pushing for looser monetary policy. So how do you read it? Well, I mean, I guess that's up to you and how you read the surrounding data, how you perceive the environment around you. And, there's the whole debate on whether rates should be cut, raised, or left the same. And we talked about that on the show. I can't remember if it was last week or the week before, but, we talked about the fact that really an interest rate is a price. Therefore, we shouldn't have government people manipulating it all, right? Now, there's no right answer. We don't know, because in a sound economic world, the market would set the interest rates. But that, of course, is not the world we live in. So we have to deal with all of this ridiculousness, and we have to parse through these crazy government data sets. So let's go ahead and break down the CPI numbers from yesterday. And of course, this is important to investors. I think that the Fed probably one of the biggest factors that drives the markets. Now, lately we've had a lot of tariff induced movement, but kind of big picture, what the Fed is doing is extremely important. And, it's interesting. I was telling one of my coworkers yesterday, I've developed this fun little game I like to play on the day that the CPI report comes out. And I like to watch the price of gold and then guess whether the data was better than expected, worse than expected, because you can tell. Gold investment is very much driven by what the Fed is doing with interest rates. So, if you watched it yesterday, it kind of held steady, and then it dropped a little bit. When it dropped, I said, yeah, kind of bad news, which I think overall, if you look at this data, there is no denying that it is showing signs of a resurgence in prices. Now, whether that will continue, that's anybody's guess at this point. But all that said, the headline annual CPI did spike from 2.4% in May to 2.7% in June. So a healthy 0.3 increase on that annual number. And that was slightly above the 2.6% expectation. That was probably the worst data point of the entire report. Of course, that is the headline number, so that's the one that really gets trumpeted. I really kind of look more at the monthly price increases, and if we take that monthly basis, all prices rose 0.3% in June, and that was in line with projections. You know, it's funny because whenever you see things in line with projections, even if they were projecting that it was going to be bad, people take that as good news. Oh, it was in line with projections. Good. Well, the projections sucked, but we're going to go with that, right? But 0.3% in June. So that's quite a bit. I mean, really, think about the fact that if you have a 0.3% monthly inflation rate over the course of a year, that annual CPI will end up being 3.6%. So, you know, that would be considered very concerning for our central banker friends over at the Fed. It was also a significant rise from May. It was only a 0.1% increase in May. So then we have to do the core CPI, which of course strips out the more volatile food and energy prices. And I think a lot of people like the core better. They kind of look at the core more closely in terms of kind of evaluating the trajectory of policy. You know, of course, normal human beings, we don't have a core CPI, right? I can't strip food and gasoline out of my budget. Must be nice to be able to do that. But anyway, so we have this core number, and that's considered to be a little bit more of a stable number because when you get those food and energy prices out, they're volatile, et cetera, et cetera. So then the core was only up 0.2% month on month, and the projection was for a 0.3% rise. So this was actually better than the projection. And on an annual basis, core CPI was 2.9%, which was in line with the expectations and the exact same number that we charted in May. Now, 2.9%, yeah, it's not bad, but, you know, the target, so I'm told, is 2%. And 2.9 is almost one more than 2. So, you know, this is where you can kind of dig into the numbers, and folks who support rate cuts can say, well, look at the core. Let's strip out these volatile energy prices and look at the core. Now, I always do this caveat every time that I talk about the CPI. I've already alluded to this fact. When you parse this data, always remember the CPI does not tell the entire story of price inflation. It's a government formula, and the government revised that formula in the 1990s. So you can't even compare, like when you hear inflation numbers from the 70s, you can't compare them to today because they've changed the CPI formula. And it actually understates the actual rises in prices now. So if you use the formula that they used back in the 1970s, CPI is closer to double the official number. So when you see 2.9, you know, that's 3, it's almost 6%. So, you know, if we were actually using a really honest formula, like the actual amount the prices are rising is probably even worse than that because, as I mentioned earlier, you know, the government has a vested interest in making you think inflation isn't as bad as it is. All of that said, this is the formula the government uses. It drives decision making, so we have to kind of look at this data. It's easy to take some of this stuff that the government throws out and go, this is just ridiculous. I'm more like this even with the employment numbers. I look at these employment numbers, and I think they're just, it almost feels like they're just pulled out of thin air. But regardless, they are important. We have to think about them because policymakers are going to use these numbers to justify decisions. And of course, what the policymakers do impacts us as consumers and investors. So, let's look a little bit deeper into the June data. Food prices, 0.3% increase in June. That's quite a bit. And on an annual basis, food prices are up 3% on the year. You know, that's something that affects all of us, right? We all go to the grocery store, we all eat. So even though they like to strip the food prices out of core, pretty significant when those prices are rising. You can look at it, and it's obvious that the tariffs are driving some prices higher. Tariff-sensitive apparel prices spiked by 0.4%. Household furnishing prices are also susceptible to tariffs, and those surged, rising by a 1% margin month on month. That's a whole lot. But then if you look at new vehicle prices, they actually fell by 0.3%, and that would be something else you would expect from tariffs. I think a lot of people kind of front-loaded their automobile buying, expecting tariffs if they were planning on buying and went ahead and bought. So maybe that's slowing down sales a little bit. I always think it's interesting to look at service prices. I have been told that service prices are kind of leading indicators of price inflation, that they tend to respond more quickly to inflation pressures. And they're, of course, also less impacted by tariffs. They're also up. So just overall services were up 0.3% month on month, and service prices have risen by 3.6% in the past year. So that's way over that mythical 2% target. Energy prices went up for the first time in a while. They rose 0.9% month to month. That was driven by a 1% hike in gasoline prices, which of course was driven at least in part by the surge in oil prices we saw briefly during the heat of the moment with the Israel-Iran thing. So again, how do we interpret this? How do we take this data and make sense out of it? How can we apply this to our decision making? Well, I think if you're a regular human being out there, the bottom line is that inflation is alive and well, right? We could talk about, it's getting a little closer to 2%. Well, 2% is still a significant devaluing of your money. So I think if you're just an average person, an investor, I think the one thing you can just check right off is the fact that inflation is alive and well. This report shows it, and we know it intuitively. But if you're trying to make sense of it in terms of what is the Fed going to do, how is this going to impact interest rates going forward, I think it's going to depend on your political bent. The financial media, I think, very fairly called it a mixed report, because you can cherry pick the parts that you want and make whatever case you would care to make, right? CNBC led its report writing, quote, "Consumer prices rose in June as President Donald Trump's tariffs began to slowly work their way through the U.S. economy." And that was pretty typical. Most mainstream headlines emphasized tariffs and their impact on prices and the connection with this moderately more warm CPI report. But, tariffs do raise prices. There's no doubt about that. Industries that are heavily tariffed, you're going to see those price pressures coming to the consumer at some point. It's not true that all of the tariffs are going to get passed along, but some of that price is going to get passed along. There's just no doubt about it. But and it's also fair to know and understand that is going to show up in the CPI, right? But customs duties do not cause inflation when you properly define inflation, right? There's only one thing that raises the general price level in an economy, which is really what we mean by inflation. And that is an expansion of money and credit. It's money printing. It's always money printing, right? When you have tariffs, it will raise the price of some things, but in a market environment, if there's not a lot of government friction going on, then other prices in the economy are going to moderate. Supply and demand tends to balance these things out. But when the government is printing money, when the money supply is increasing, that's when you see all prices rising. And of course, the CPI is going to reflect this, but depending on how they formulate that basket of goods, tariffs will show up in there to a lesser or greater degree. So anyway, I talk about this a lot. I really, really hammer this because it's like this big thing in my head, I guess. But it frustrates me that inflation is so badly defined and explained. We're so imprecise when we talk about it, right? And you'll notice I try to use the term price inflation when I'm talking about rising prices to kind of distinguish that from monetary inflation, which is that increase in the money supply. But Henry Hazlitt, folks who are knowledgeable in economics will recognize his name. He published a brilliant book called Economics in One Lesson. And one of the most influential books on me in my early development in both my political and economic views, incidentally. And you can actually find Economics in One Lesson online, download it for free. But anyway, he also wrote another essay that was titled Inflation in One Page, and he explained why using more precise definitions when we're talking about inflation, it's crucial. He said, inflation is an increase in the quantity of money and credit. And that used to be what everybody understood. Like if you went back in the 70s and said inflation, that definition is what people would think of. Now today when you say inflation, they just think rising prices, which is a masterful propaganda campaign by the government. And Hazlitt goes on and he says, it's the inflation, its chief consequence is soaring prices. So monetary inflation results in rising prices. Hazlitt goes on, therefore, inflation, if we misuse the term to mean the rising prices themselves, it is caused slowly by printing money. For this, the government's monetary policies are entirely responsible. So I just want to hammer on that point when we're talking about inflation, when we're talking about CPI. Inflation, monetary inflation, and price inflation are two different things. CPI will give us some insights into the impacts of monetary inflation, but it's not monetary inflation. It is not measuring inflation, okay? Now, another thing that I've been saying for months, the Federal Reserve tightened monetary policy. It did so enough to rein in rising prices. We have seen a cooling, over what we were seeing a couple of years ago when we had, the CPI measuring close to 9% price inflation. But it never did enough to slay the inflation dragon. Don't forget how much inflation, how much money has been injected into the U.S. economy since 2008. Close to $9 trillion. That is inflation. That's why we're perpetually caught in this rising price spiral, right? And when you look at the trajectory now, we have inflation again. Inflation, properly defined as an increase in the money supply, has been going on for over a year now. You can go look at the M2 numbers. You can look at other metrics that measure the money supply. The monetary system is relatively loose right now, despite all of the jabbering about tight monetary policy. But then on the other side of the coin, President Trump and those who are pushing for rate cuts can point to that core CPI data that we've already mentioned, and they can plausibly argue that price inflation is pretty muted. And while there are signs that price inflation is heating up a little bit, it remains cool compared to what we were seeing a year ago. And the fact of the matter is, I don't think it's as bad as a lot of the people that were really hammering Trump for the tariffs. I don't think it's as bad as a lot of them expected or made it sound like it was going to be. So you could make arguments on both sides of the coin. Is the guy carrying the knife here? Is he trying to murder you? Is he going to cut you a roast? So, given the fact that the money supply is expanding and financial conditions are loose from a historical standpoint, caution in cutting is warranted from that perspective. And, if you're just going to take the CPI at face value, it probably should signal some caution. After all, none of the metrics are close to that mythical 2% target. So, you can go either way, is really what I'm getting at here. And they will. The pundits and the politicians are going to debate this. You're going to hear both sides of it. Both are plausible. But you have to look at it deeper than that. It's not just about the rising prices. It's not just about tariffs. It's about money creation, right? And, I'll say this too. Trump and others that are pushing for rate cuts aren't wrong. Now, I think that in a real market economy, I think interest rates would probably be higher than they are now in a natural environment. That's just my opinion. But we don't know because we live in this world where we have this massive government intrusion into interest rates. But the fact of the matter is a higher interest rate environment will eventually crack the debt-riddled economy. It's going to pop the bubbles that all of the easy money blew up to begin with. And the economy needs its easy money drug, right? However, a few good CPI reports notwithstanding, inflation is far from dead. It is a catch-22. It is a rock and a hard place. And I've been talking about this for well over a year, and it's still there. It's taking a long time for this to play out, which shouldn't be surprising if we look at the timeline of other, booms and busts. But it's a catch-22, and the CPI report's not going to make that decision-making any easier. And, I think we're going to see the status quo. I think we're going to see this tension between cutting and keeping rates higher. I think ultimately they are going to cut. Everything seems to indicate that the Fed is going to cut once at least probably twice before the end of this year. So what that means is you're going to get more inflation, right? You're going to get more inflation as properly defined, because when they start cutting rates, it's going to loosen the monetary system up even more. And that is going to result in an increase in the money supply, which is the root cause of price inflation. So it's hard. I don't know. I'm glad I don't have to make that decision. But I'll tell you one decision that seems pretty easy, and that's to buy some more silver. On Monday morning, silver briefly traded above $39 an ounce. And even at that price, I could make a good case that it is still underpriced. And I can make that argument using several different dynamics. I've talked about all of this before on the show, these various metrics and the case for silver, but I want to go ahead and make it again because, I feel like we kind of had this surge in the silver price, and now we're kind of in this consolidation phase. And I think a lot of people, they're looking at $39, $38 silver and like, ooh, this is, huge, but all of these metrics tell you that there is still more room for things to go up. So first, there's the gold-silver ratio, and I've talked about this a lot on the show. It tells you how many ounces of silver it takes to buy 1 ounce of gold. And when I looked at it a little while ago, the ratio was right at 88-1. And as I've talked about on the show before, that ratio has averaged closer to 60-1, if you kind of average it out over time in the modern era. So in other words, even with the recent rally, silver is still significantly underpriced historically compared to gold. Now, it's come down. I think we got up to over 100-1 for a little bit right before the big rally. But that spread is still historically wide, is kind of what I'm getting at. And of course, whenever the gold-silver ratio gets out of whack like this, it eventually snaps back to the mean. Most things do return to the mean at some point. And this usually happens with a surge in the price of silver. So this is kind of still, on the plate. And this has often happened, this closing of the gap has often happened in the midst of a gold bull rally and later into that gold bull rally, with silver ultimately outperforming gold. So we can go back, we can look at 2020. During the pandemic, the gold-silver ratio actually set a record then. It got as wide as 123-1. As the COVID hysteria gripped the world, the price of silver crashed because the economies were shut down. And then when they, started to realize that the impact of the economy was going to be, gold took off, and then silver eventually followed. And that ratio fell back to around 60-1. As central banks around the world cranked up the money creation machine to cope with the government shutdowns of their own economies. Another even more striking example of this snapback was back in 2011. We saw the gold-silver ratio fall to 30-1, and that was after rising to over 80-1, kind of where we are now during the money creation of the Great Recession. So, again, as I mentioned before the rally, the ratio was over 100-1. So silver has closed that gap to some degree, but there's still a long way to go before we're back to the historical average. And then, we've talked about this before as well. Silver seems to be underpriced given the supply and demand dynamics. Silver demand outstripped new supply for the 4th straight year in 2024. And we saw industrial demand set another record. So that structural demand with demand exceeding supply was 148.9 million ounces. So there was 148.9 million ounces used more than what was pulled out of the ground or recovered through recycling. So where does that gold come from? Well, they have to pull it from somewhere else, from existing stocks above ground, and that tends to put upward price pressure on the metal. So these market deficits are projected to continue. And, when investors hop on the train, we could see even larger supply deficits because most of this has been driven by industrial offtake. In fact, last year, we saw investment demand drop, and overall demand was actually a little bit lower than 2023. We still had this big market deficit, this shortfall in supply, but this was really without investor participation. So looking at some of the other dynamics, we also have an extremely bullish technical setup. It's the classic cup and handle chart. I've talked about this on the show as well. I'll post an image or a chart showing the cup and handle on the show notes page. But if you look at it, you'll see the cup. There's twin peaks when silver hit highs of around $50 an ounce. One was in 1980, one was in 2011. So you take those as the high points, and then you draw a little, curved line between those two. You get the cup. And then following that 2011 peak, we see a sharp decline in the price, followed by a consolidation handle. And if you look at it now, we're starting to see it break out of that handle. And that is when you're kind of seeing what technical analysts would say the beginning of a big breakout. So that setup looks really good. And this cup and handle pattern has played out over an extremely long time frame. I mentioned that the first peak was in 1980, so it's called a secular cup and handle. It's long, it's a big pattern. And these typically pretend a bigger breakout with a even broader base. So that means a bigger upside case. So, we actually saw a very similar pattern with gold that resolved with the breakout to the new all-time highs back in 2023. So very similar to what we saw. It's just that silver's kind of behind gold, which isn't really unusual. Analyst Clive Mond argues that the technicals now show that silver is poised for another up leg, similar to the one that we saw in June. I will post that article on the show notes page as well. It's published over at moneymetals.com/news. So taken together, the technicals, including the gold-silver ratio, and the supply and demand dynamics tell us that despite the recent rally, silver is still on sale, and there's plenty of life left in those silver bull legs. And I mentioned investors. We're starting to see them come to the table. Last year, as I mentioned, record industrial demand led to that market supply deficit, but investment demand was tepid. Not anymore. Through the first half of 2025, we saw inflows of silver into ETFs that have eclipsed the total for the entirety of 2024. So we had more silver going into ETFs through the first 6 months of this year than the entirety of last year. And this reflects this surge of silver investment demand. Now, most of it is overseas right now, but it's definitely there. Kind of looking at the price performance, the average annual price of silver was up 25% in the first half of the year, and that was comparable to gold. Gold was up about 26%. So they're kind of marching arm in arm right now. So looking at these ETF stats, through the first 6 months of the year, 95 million ounces of silver flowed into ETFs globally. That's a lot of silver, 95 million ounces. And that pushed the total ETF fund holdings globally to 1.13 billion ounces. And this is all according to data that's compiled by the Silver Institute. So that's about 7% below the all-time high for silver ETFs, which was 1.2 billion ounces back in February of 2021 during the pandemic times. So with the value of silver rising, the value of ETF holdings hit a series of all-time highs in June, and it exceeded $40 billion for the first time. So even though there's not quite as much silver in the funds as there were at that record back in 2021, the value of the silver is actually at record levels now. ETF inflows were relatively constant through the first 5 months of the year. Then there was a huge surge in June, with more than half of the gains coming in the final month of H1. It was the most significant monthly increase in silver ETF flows since the Reddit silver squeeze in early 2021. Now, it's important to consider the impact of this ETF flow on a silver market that is already operating at a supply deficit. ETFs are one of the places that industry could bid silver away, right? If the electronics industry needs more silver, ETFs are one place that physical silver exists. So this is impacting the entire supply and demand dynamic. Now, it's not just ETF investment. Retail silver investment in physical metal has also been strong in both Europe and Asia, but still tepid in the U.S. Retail silver investment in Europe began to rebound last year, and that momentum has continued through the first half of 2025. But the growth is coming off of a relatively low base, and investment volume in Europe still lags the elevated level that we saw during the pandemic era. But bottom line is more investors in Europe are starting to accumulate physical silver. According to the Silver Institute, the European silver market has benefited from a slowdown in secondary market liquidation. And this has lifted demand for newly minted bars and coins. So in other words, people aren't selling their silver back. There's a tight market for older coins. So we're seeing higher demand for newly minted coins in Europe. Looking at Asia, big increase in physical silver investment. India was the primary driver. And the Indian retail market posted a strong 7% year-over-year gain in H1, according to the Silver Institute. And they say this reflects, quote, strong expectations that the price is going to continue to go up. Now, in contrast to all of this, investors here in the U.S. have taken advantage of higher prices and are tending to sell silver. According to the Silver Institute, retail demand in the U.S. fell around 30% through the first 6 months. Quote, this dynamic selling along with weak retail purchases have weighed heavily on new bar and coin sales as some U.S. investors have been encouraged by multi-year high prices to book profits. Furthermore, the absence of a crisis in the U.S., like the collapse of the Silicon Valley Bank in 2023, has reduced safe haven purchases. So pretty typical. You know, it's interesting because we've seen this with gold as well. Asia has really driven the recent gold bull rally, with U.S. investors kind of sitting on the sidelines. With the gold market, we also have the central bank that has really helped buoy that. And now we're seeing the same thing with silver. Asians all in, Europeans sticking their toes in the water, Americans still not so much. I think if you are ignoring silver right now, you're missing potentially a really good opportunity. Again, when you go back and you look, technicals, gold-silver ratio, supply and demand dynamics, things look really good for silver, you know? And it's interesting that Americans are still spurning silver. And, you know, for me, when I started getting into precious metals investing, silver was kind of the way in, right? I couldn't afford, you know, at the time, even $1,800 to plunk down at a given time for, you know, a single gold coin. So it was much easier to begin accumulating silver. And I think a lot of people do that. It gives you the same type of exposure because if you look at historically, silver and gold have tended to rise and fall together. Silver is much more volatile. You have the industrial component of it. Definitely, you know, that's a factor. But because of silver's history as a monetary metal, and because most people still view it in that kind of framework, even if governments don't, silver and gold tend to go together. And silver ultimately tends to behave as a monetary metal. So the good news, I guess, is that it's not too late. I think that, you know, $37, $38, $39 silver is still a good bargain. You know, if you're looking at an all-time high of $50, if you get in now, you're still looking at a lot of upside. And I don't see any reason to think that we won't approach record highs at some point, you know, again, given the fact that all of these things are still in place to keep driving gold higher. And we've talked about that on the show as well. So now's the time. Perfect time. Call Money Metals, 800-800-1865. Talk to a Money Metals precious metals specialist. Find out how silver might fit into your investment strategy and gold as well. And, you know, if you're like me when I was younger and trying to get into investing, if you can't put down a big bunch of money at one time, check out the program that we've got where you can actually do an installment plan where you accumulate gold and silver over time. It's a really cool program. Ask them about that. But they're fantastic. They're there to help you. I know some people don't like to talk on the phone. That's cool. Go to moneymetals.com. You can chat with the precious metals specialist right there online. Or if you don't want to do any of that, you just want to buy some silver, buy some gold, you can do it online on our online platform. Very simple to use, and you shouldn't have any problem at all. So do it today. Don't wait, right? You want to get your insurance before there's a fire. And there's going to be a fire. It's just a matter of when, not if. So, before I go, for next week, I want to do an Ask Mike Anything segment of the podcast. I'm going to record it over this weekend because I'm going to be out of town next week. So if you have questions that you would like to ask me, preferably gold, silver, economy related, but I'll entertain other ideas. But you can do that. You can email me, mike.maharrey, MikeMaharrey @moneymetals.com. Shoot me an email, ask me a question, and if it's a good one, I'll try to get it on the show next week. With that, we're going to call it a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything that I've talked about on the show today and a whole lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, sign up, get on our email list. Now, of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, make sure that you tune in to our Market Wrap podcast every Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and a lot of other interesting people from the world of gold, silver, economics, and investing. Thank you so much for listening to the show. I really do appreciate it. I know you've got a lot of choices and stuff that you could be listening to and spending your time doing. Thank you for spending a little time with us. If you want to help, I'm not going to ask you for any money, but if you would go, share the episodes, give us the good reviews, crush those like buttons. It helps the algorithm and gets us in front of more listeners. So if you would do that, I'd appreciate it. And with that, we're out. Have a great rest of your day, and we'll talk to you again next Wednesday.